Hey, good morning, folks. Hope you're having a great weekend. It's JJ from Micro E Futures and Equities ETC. Doing a quick breakdown to show folks how I look at a stock and whether that stock is suitable for trading and whether or not you should maybe be a longer term holder in a stock or you're trading something for short-term gains. I'm also going to talk a little bit of how not to get trapped short, which is a very common theme in this market that most people are experiencing. I'm going to use this stock as an example. Um, Actually, my girlfriend brought it to my attention. SG, it's some sort of a restaurant chain. Doesn't even matter what they do. We're going purely on what the chart's telling us. Okay. So, first of all, I'm going to talk a little bit about this stock. You can go take a look and see how it's structured. It's only got 101 shares outstanding, of which 98 is in the float, which means that's 98 million shares are in the float available for trading. Now, 94% of that float is held by institutions. Okay. So that means there's not very much stock available for public trading because these institutions are such Bailey Gifford, Fidelity, Vanguard. They're investors. They're not traders. So they buy stock, they put it away for decades unless there's a material change in the business of the company. Okay. And so what happens now in a stock like this is because it's thinly traded, only maybe 3 to 4 million shares trade a day. So if a large order comes in or a large group of orders come in, there's not a lot of liquidity to absorb those orders, and therefore the price is going to move around a lot. So you can see how, you know, back here, they ran the stock, they did some distribution, and then the stock gapped up. And this is another thing with stocks that are thinly traded, right? Even there's 98 million shares in the float. There's really only about 6% of it that's available for trading, right? And only 3% of it actually trades on a daily basis. So you got to think about these things. So you got a big gap, which is a shortage of supply. The swing traders and those types of traders, you know, the wholesalers and large traders, who move positions, they do some distribution and then right back down to the original cost basis. So as you can see the volume point, this high volume node that you guys call it, that's what we call cost basis. So there's accumulation, distribution, back to accumulation. Now, what we're doing here in this blue box, that's a balance zone, and we're cleaning up these sellers down into this balance zone. So what you want to do is you want to look at the bottom of that balance zone, and when you get a liquidation underneath it, instead of just following it, thinking that the stock's got to go lower, right? If it's a thinly traded stock, the next day you'll notice the bottom of that candle got nowhere near 23 and 23.46. And in fact, what happens is you look below the balance level, you fail, and you come back up. The top of balance is your target, right? If you can't break balance, then you're going to rotate back down. But this rotation does a couple of things. It's like a washing machine that cleans out the trapped overhead supply into wholesale hands. And then all of a sudden, stock gaps again, another supply gap, right? Where you have a shortage of supply, right? You've got a shortage of supply here, here, and now shorts are trapped underneath 2762, right? And now we're back into that distribution phase. So this is how you got to look at these stocks. You got to remember that companies, like a house, like any kind of a structure, right, are built a certain way, right? And the company will trade the way it's been built. So if a company has a lot of stock in the float, it's going to take a lot of buying or selling to move that stock, large size, right? But if that stock is held by large institutions, in this case, right, you've got 94% of the available stock held by people who don't trade it. So they buy it and they lock it away, right? Unless something with the company changes, right? So always remember that these are a few simple little things that we look at because if you're going to trade stock, if you're going to invest, you might as well learn from someone who's actually taken companies public and structured companies so they would trade a certain way. Some companies are traded where price is low and there's a lot of available stock that can go back and forth and back and forth. It's a nice liquid market. Some companies are structured in different ways for more of an investment appeal. This particular stock wants people to invest in it. They don't want people to trade in it. You can tell by the chart because it wipes out the traders and it's very, very light. It's a light volume stock. So there's not a lot of transactions. There's not a lot of liquidity, right? So just watch these things, use these balance zones. We love it. The look below and fail is a great long trade. If you're a swing trader, works really nicely. You can do that. And then if, we have a market sell-off, you can always double the balance zone to the bottom to look for potential targets. In this case, we doubled the balance zone to the top, and as the market progresses and stays over certain levels, you can target the upper level. It's a simple way to trade. It has to do with the business because you acquire a cost basis and you sell it at a profit. I'm JJ. We're teaching this all in our rooms. We teach how markets are structured, how you can take intelligent trades with good risk management, learn how to trade properly. We are also going to be putting out a course on equities trading, right, and longer term investing, how to tear apart a public company quickly. Come check us out at Equities ETC and microefutures.com. I'm JJ. I hope you have a wonderful weekend. And thank you so much for listening. Bye for now.